Hello everyone, welcome to the 122nd episode of me learning how to trade in Forex. So in the last episode we covered how to read currency correlation tables. We went through what the correlation coefficient means. So positive correlation of +1 means both of the variables have a strong positive relationship, meaning if one goes up, the other also goes up. A negative correlation of -1 means a strong negative relationship, so as one goes up, the other goes down, and is vice versa. No correlation with a coefficient of 0 means it's completely random. One may go up, the other may go up or down, who knows. So that's that, and then we went through each of the currency correlations. So one currency pair in correlation with another currency pair over, was it 1, 2, 3, 4, 5 sort of different time periods. And yeah, so now we're on to, are you doubling your risk without knowing it? So are you doubling your risk without knowing it? Date is the 1st. So are you doubling your risk without knowing it? When you are simultaneously trading multiple currency pairs in your trading account, always make sure you're aware of your risk exposure. Ensure you're aware of your risk exposure when you are simultaneously trading multiple currency pairs. For example, on most occasions, trading AUD-USD and NZD-USD are essentially like having two identical trades open because they usually have a positive correlation. You might believe that you're spreading or diversifying your risk by trading different pairs, but many pairs tend to move in the same direction. So instead of reducing your risk, you are magnifying your risk. Unknowingly, you're actually exposing yourself to more risk. This is known as overexposure. So overexposure, the belief that you're spreading or diversifying your risk by trading in different pairs. However, many pairs tend to move in the same direction, which magnifies your risk instead. Let's look at an example involving two highly correlated pairs within a 1 week period, the Euro-USD and GBP-USD. So Euro-USD and GBP-USD. Based on the table, with a sexy correlation coefficient of 0.94, there's obviously a high correlation in this particular pair. Euro-USD is a peanut butter to GBP-USD's jelly. Like oil and water, like Ben and Jerry's. Euro-GUSD, Ben and Jerry. Okay, you get the picture. The point is that the two pairs hold hands, sing Kumbaya and skip together. Currency correlation example number 1, Euro-USD and GBP-USD. To prove to you that the numbers don't lie, here are their 4-hour charts. Notice how they both moved in the same direction, down. So overall trend going down here, overall trend going down here. We can also see some similarities like over here where this bit goes up, this bit goes up, this bit goes down, it also goes down here. So returning to the subject of risk, we can see that opening a position in both the Euro-USD and the GBP-USD is the same as doubling up on a position. For example, if you bought one lot of Euro-USD and bought one lot of GBP-USD, you're basically buying two lots of Euro-USD. because both the Euro USD and the GBP USD would move in the same direction anyway. In other words, you are increasing your risk if you buy Euro USD and GBP USD. You don't get two chances to be wrong. All you get is one chance, because if Euro USD falls and you get stopped out, GBP USD will most likely fall and stop you out also, or vice versa. You also wouldn't want to buy Euro USD and sell GBP USD at the same time, because if Euro USD skyrockets, then GBP USD will probably skyrocket also, and where does this leave you? You get stopped out in one currency pair. If you think your profit or loss will always be zero, then you're wrong. Euro USD and GBP USD will have different pip values, and just because they are highly correlated doesn't mean they always move in the same exact pip range. Volatility within currency pairs is fickle. So, volatility within currency pairs is fickle. Euro USD can skyrocket 200 pips while GBP USD only goes up 190 pips. If this happens, the losses from your GBP USD trade, because you are short, will eat up most if not all of the gains from a Euro USD trade. Now let's imagine, so if Euro USD can skyrocket 200 pips, so goes up, while GBP USD only goes up 190, if this happens, the losses from your GBP USD trade, because you are short, will eat up most, if not all, of the gains from your Euro USD trade. Now let's imagine that Euro USD was the pair that moved up 190 pips, and GBP USD had the bigger move at 200 pips. You would have definitely had a loss. Going long one currency pair and going short another currency pair that are highly correlated is extremely counterproductive. Going long one currency pair and going short another currency pair when they're highly correlated is extremely counterproductive. More than paying for the spread twice, you minimize your gain because one pair eats into the other pair's profits. As one pair cancels out the other pair's profit. And even worse, you could end up losing due to the different pip values and ever-changing volatility of currency pairs. Currency correlation example number 2. Euro USD and USD CHF. Let's take a look at another example, this time of the Euro USD and the USD CHF. While we just saw a strong positive correlation with the GBP USD, the Euro USD has a very negative correlation with the USD CHF. So Euro USD and USD CHF -1. So moving in opposite directions. If we look at its 1 week correlation, it has a perfect correlation coefficient of -1. It doesn't get any more opposite than this, folks. Instead of Ben and Jerry's, they're Tom and Jerry. Euro USD and USD CHF are like fire and water, Bugs Bunny and Elmer Fudd, Superman and Kryptonite, Boston Celtics and Los Angeles Lakers, Manchester United and Liverpool. These two pairs totally move in the opposite directions. Check out the charts. One goes down, other goes up. So we can see that this bit kind of mirrors as well. So this one goes up, this one goes down. This one goes down, this one goes up. This one goes down, this bit goes up. This goes up, this goes down, kinda. Very, very opposite. Taking opposite directions on the two negatively correlated pairs will be similar to taking the same position on two highly positive correlated pairs. Taking opposite positions on the two negatively correlated pairs would be similar to taking the same position on two highly positive correlated pairs. Buying Euro USD and selling USD CHF would be the same as doubling up on a position. Whoa, I need to make some notes, picture notes. like this. And then wait, I just realised, so in this one, when they're both highly correlated, you can't, well, if you buy both, or if you go short on both, then you're doubling up on a position, right? So that means you're increasing your risk. So that's when you buy both. But then if you buy one and then sell the other one, then it becomes counterproductive, as one pair cancels out the other pair's profit. So what would you do then? So if you go the same position on both, then you're increasing your risk. But then if you go the opposite positions on both, then you're cancelling out your profit. So what? So you kind of have to double up on a position then, don't you? Because even if you do make a profit on the make a profit by going the opposite positions, they're going to cancel out anyway, and the losing position might make more loss than the winning position. So then overall you're still going to be negative. So isn't it much better to just double up on a position then? Because doing it the opposite direction, doing it the opposite positions, means that you're not even going to make any profit maybe, or it's going to be really minimal. So what's the correct way to do this then? Okay, so two different charts. Taking opposite positions on the two, buying Euro USD, so buying this, and selling USD CHF will be the same as doubling up on a position. Taking opposite positions on the two highly negative correlated pairs would be similar to taking same position on two highly positive correlation pairs. Buying Euro USD and selling it would be the same as doubling up on a position. For example, if you bought one lot of Euro USD and sold one lot of USD CHF, you've basically buying two lots of Euro USD. Because if Euro USD goes up, then USD CHF goes down, and you're making money on both pairs. It's important to recognize that you have increased your risk exposure in your trading account if you do this. Well, you kind of have to, otherwise you're not going to make a profit then, are you, right? Returning to the example of you being long Euro USD and short USD CHF, if Euro USD actually dropped like a rock, most likely both of your trades would be stopped out, resulting in two losses. You could have minimized your loss by simply deciding to go long Euro USD, or go short USD CHF instead of doing both. Oh right, so only trade one pair at a time instead of doing two pairs at the same time. On the other hand, buying or selling both Euro USD Euro USD and USD CHF at the same time is usually counterproductive, since you're basically cancelling each trade out. Because the two pairs move in the opposite directions, like they hate each other's guts, one side will make money but the other will lose money. So either end up with a little gain because one pair isn't the other's pair profits, or you could simply end up with a loss due to each pair's different pip values and volatility ranges. Right, okay, so what they're saying in this lesson is basically just only trade one currency pair at a time if they're both highly correlated with each other or highly negatively if they're both highly positive, if they're both highly positively correlated with each other, or if they're both highly negatively correlated with each other. taking opposite positions on the two negatively correlated pairs would be similar to taking the same position on two highly positively correlated pairs, because you're doubling the risk. Buying Euro USD, you can either make big money or you could lose. Well, not. Yeah, you could either make big money or lose big money, because with the two highly positively correlated pairs, if you go take the same position, if you do, like, say, go short, then you make loads, but then if you go long, then you lose loads as well. Whereas this, the opposite, the highly negatively correlated ones, taking the opposite direction. So if you go, let's say, long on this one and then short on this one, then you lose both the trades, so you lose loads. But then if you go short on this one and then long on that one, then you make loads, because you're right on both trades. So yeah, same theory, basically, same theory here. Buying Euro USD and selling USD CHF would be the same as doubling up on a position. For example, if you bought one lot of Euro, you have increased your risk exposure in your trading account if you do this. Therefore, you are increasing your risk exposure if you do this. Returning to the example, you could have minimized my loss by simply going long. So to minimize losses, choose whether to go long or short in one currency pair instead of both. Buying or selling, same time, usually cannot, since you're basically cancelling each other out. Yep. One side will make money, little gain, or simply a loss, because yep. Buying or selling both the currency pairs is also counterproductive, since one pair will make profit and the other pair will make a loss. Which cancels each other out. So you either end up little gain because one pair isn't the other pair's profits, or you could simply end up with a loss due to each pair's different pip values and volatility ranges. Cool. 5 reasons why factoring in currency correlations help you trade better. Currency correlation tells us whether two currency pairs move in the same, opposite, or totally random direction over some period of time. When trading currencies, it's important to remember that since currencies are traded in pairs, that no single currency pair is ever totally isolated. No single currency pair is totally isolated. Correlation is computed into what is known as the correlation coefficient, which ranges between -1 and +1. Here's a guide for interpreting the different currency correlation coefficient values. So, -1, perfectly inverse correlation. -0.8, very strong inverse correlation. -0.6, strong high inverse correlation. -0.4, moderate inverse correlation. -0.2, weak low inverse correlation. 0, no correlation, totally random. 0.2, very weak insignificant correlation. 0.4, weak or low correlation. 0.6, moderate correlation. 0.8, strong high correlation. 1, perfect correlation. So now you know what currency correlation is and how to read it off a fancy chart. But we bet you're wondering how using currency correlations will make your trading more successful. Why do you need this wondrous skill in your trader's toolbag? There are several reasons. Reasons for using currency correlations. Eliminates counterproductive trading. Counterproductive. Utilizing correlations can help you to stay out of positions that will cancel each other out. So help you stay out of positions which will cancel each other out. As the previous lesson showed, we know that Euro USD and USD CHF move in the opposite direction almost 100%. Opening a position long Euro USD and long USD CHF is then pointless and sometimes expensive. In addition to paying for the spread twice, any movement in the price will take one pair up and the other pair down. We want our hard work to pay off with something. Leverage profits. Leverage profits or losses. You have the opportunity to double up on a position to maximize profits. Again, let's take a look at the 1 week Euro USD and the GBP USD relationship from the example in the previous lesson. These two pairs have a strong positive correlation with GBP USD, following behind Euro USD virtually step for step. Opening a long position for each pair would in effect be like taking Euro USD and doubling your position. You'll basically be making use of leverage. Mucho profit if all goes right and mucho losses if things go wrong. Leverage, since positions are doubled, this shows the use of leverage to gain. This shows the use of leverage, which magnifies why can't I spell it right? Your profits and losses. Diversify risk. So, understanding that correlations exist also allows you to use different currency pairs, but still leverage your point of view. Rather than trading a single currency pair all the time, you can spread your risk across two pairs that move the same way. Pick pairs that have a strong to very strong correlation, around 0.7, for example. Euro USD and GBP USD tend to move together. The imperfect correlation between these two currency pairs gives you the opportunity to diversify, which helps reduce your risk. Let's say you're bullish on the USD. Instead of opening two short positions of Euro USD, you could short Euro USD and short GBP USD, which would shield you from some risk and diversify your overall position. In the event that US dollar sells off, the euro might be affected to a lesser extent than the pound. But didn't they say that it's gonna, increase your risk because you're pretty much opening the same position twice? So, yeah. Okay. Anyways, diversify risk. So rather than trading a single currency pair all the time, you can spread your risk across two pairs which move the same way. So pick pairs that have a strong correlation which move together. Strong positive correlation which move together. Then a pound. Yep. Hedge risk. So hedge risk. Although hedging can result in realizing smaller profits, it can also help to minimize loss. Hedging can result in realizing smaller profits. If you open a long Euro USD position and it starts to go against you, open a small long position in the pair that moves opposite Euro USD, such as USD CHF. Major losses averted. So open a small long position. You can take so if you open a long and it starts going against, so if it drops instead of going up, then you open in a pair that moves opposite. If it moves opposite, then it's gonna go up. So then you go long and then it makes profit. Oh, I see. Yep. Major losses averted. You can take advantage of the different pip values for each currency pair. For example, while Euro USD and USD CHF have an almost perfect -1 inverse correlation, their pip values are different. Assuming you trade a 10,000 mini lot, 1 pip for Euro USD equals $1 and 1 pip for USD CHF equals 0.93 dollars. If you buy 1 mini lot Euro USD, you can hedge your trade by buying 1 mini lot of USD CHF. If Euro USD falls 10 pips, you'll be down $10, but your USD CHF trade will be up to $9.3 dollars. Instead of being down $10, you're only down 0.7 dollars. Even though hedging sounds like the greatest thing since sliced spread, it does have some disadvantages. If Euro USD rallies, your profit is limited because of the losses from your USD CHF position. Also, the correlation can weaken anytime. Imagine if Euro USD falls 10 pips and USD CHF only goes up by 5 pips. Stays flat or falls also. Your account will be bleeding redder than the Red Wedding in the Game of Thrones. So be careful when hedging. Right, okay, so hedge risk. If opening a long position and the currency pair moves the opposite direction, open a small long position in a currency pair that moves has a negative correlation with the first currency pair. Sumi equals, instead of being known down. However, hedging has disadvantages such as if Euro USD rallies, your profit is limited because the losses from your USD CHF position. The correlation can weaken at any time. If Euro USD rallies, so what was it? Open a long position. Such as the correlation can weaken in time. And the first currency pair rallying, which limits your profit as the losses due to the losses from the second open position. Second currency pairs open position. So be careful when hedging. Confirm breakouts and avoid fakeouts. Confirm breakouts and avoid fakeouts. You can use currency correlations to confirm your trade entry or exit signals. Can use currency correlation to confirm trade entry or exit signals. For example, the Euro USD appears to be testing a significant support level. You observe the price action are looking to sell on a breakout to the downside. Since you know Euro USD is positively correlated with GBP USD and negatively correlated with USD CHF and USD JPY, you check to see if the other three pairs are moving in the same magnitude as Euro USD. You notice that GBP USD is also trading near a significant support level, and both the USD CHF and USD JPY are trading near key resistance levels. This tells you that the recent move is US dollar related and confirms the possible breakout for Euro USD since the other three pairs are moving similarly, so you decide that you will trade the breakout when it occurs. Now let's assume that the other three pairs are not moving in the magnitude as Euro USD. The GBP USD is holding, not falling, USD JPY is not rising, and USD CHF is sideways. This is usually a strong sign that the Euro USD decline is not US dollar related and most likely driven by some kind of negative EU news. Price may actually trade below the key support level if you've been monitoring, but because the other three correlated pairs aren't moving in proportion of Euro USD, there will be lack of any price follow through and the price will return back above the support level, resulting in a fake out. If you still wanted to trade a setup, since you didn't get any correlation confirmation from the other pairs, you could play it smart by reducing your risk and trading with a smaller position size. Yep. Exit signals. So, be careful, currency correlations change. Careful. Currency correlations change. The Forex market is like a schizophrenic patient suffering from bipolar disorder who constantly eats chocolates, experiences extreme sugar highs, and has volatile mood swings all day long. We're not even exaggerating. Although currency correlation between currency pairs can be strong or weak for days, weeks, months, or even years, they do eventually change and can change when you least expect it. Currency correlations can change and they do eventually change when you least expect it. The strong currency correlations you see this month may be totally different next month. Have a look at the table below. So USD JPY compared with USD CHF, weak positive correlation for 1 week. Kinda moderate negative correlation in 1 month, and then moderate positive correlation for 3 months. Strong correlation, positive correlation for 6 months, and then strong positive correlation for 1 year. Compare the coefficients for a given pair across the different time frames. Did you notice anything? For the most part, thanks to USD JPY, they are different across the boards. Alright, across here. Changing from one time frame to another, and they change in all directions. So one goes from positive to negative. We've also got some negative to positive. Yeah. The lesson here is that the currency correlations do change, and they change frequently. Change frequently. And they can change by a drastic measure in a short time frame, as is apparent by looking at Euro USD at the 1 month and 3 month interval. 1 month, 3 month. Yeah, so from positive to negative. That's a big swing. Because of the constant sentiment shifts of the currency market, make sure you're aware of the current currency correlations. Sure you're aware of the current currency correlations. For example, over a 1 week period, the correlation between USD JPY and USD CHF was 0.22. This is a very low correlation coefficient and would indicate that the pairs have an insignificant correlation. However, if we look at the 3 months data for the same time period, the number increases to 0.52 and then 0.78 for the 6 months and finally to 0.74 for a year. In this example, you can see that these two pairs had a breakup in their long-term correlation relationship. What was once a strongly positive correlation association in the past has extremely weakened in the short term. If they were a real couple and had only dated a month or less, they would have thought they were incompatible. Little do they know the passion will start heating up later. If you look at Euro USD and GBP USD, here's an example of the extent to which currency correlations can change and jump around. The 1 week period shows a very strong correlation with a 0.94 coefficient, but this relationship severely deteriorates in the 1 month period, dropping to 0.13, before improving again for its 3 month period to a solid 0.83, then deteriorating again to a weak correlation in its 6 month trailing period, and then in a year's time it goes up to a very strong positive correlation again. Here's a crazy example of how dramatic currency correlations can change. Let's take a look at the USD JPY and the NZD USD. We can see 1 week, no correlation at all, barely any. 1 month, pretty decent positive correlation. 3 month, no correlation at all. 6 month, now we're onto a pretty moderate negative correlation now. And then 1 year, still an increase in the negative correlation. So it went from no correlation to positive correlation to no correlation to negative correlation and then to negative correlation again. So quite a lot of mood swings. their 1-year correlation coefficient was minus 0.69. This indicates a moderate to strong correlation. But if you look at their 1-month correlation, the correlation coefficient essentially flip-flopped. So be careful. Currency correlations change for many different reasons. These can include anything from a country changing interest rates to shifting monetary policies, or any collection of economic or political events reshaping traders' sentiment on a currency. Currency correlations change for many different reasons. These can include a country changing interest rates, shifting monetary policies, or any collection of economic or political news reshaping traders' sentiment on currency, or any economic or political news, political events, news or events which reshape the traders' sentiment on a currency. Currency correlations change for many different reasons. These can include a country changing interest rates, shifting monetary policies, or any economic or political news or events which reshape the trader's sentiment on a currency. Cool. I am going to leave this episode here then. So in the next video we're going to cover how to calculate currency correlations with Excel. And yeah, so thank you all for watching, and I will see you guys in the next video. Goodbye.